Welcome to Ind AS 23, borrowing costs. Borrowing costs, that is interest and other costs in connection with borrowing, that are directly attributable to the acquisition, construction or production of a qualifying asset. What is a qualifying asset? An asset that necessarily takes a substantial amount of time to get ready for its intended use or sale, form part of the cost of the asset. Other borrowing costs are recognized as an expense. So first thing is, borrowing costs are interest and other costs. Other costs means costs that are incurred for arranging a loan. So there is two things. Example could be what? Transaction costs. When an entity assumes a liability. So this other costs, for example transaction cost, these are all incurred before the liability is assumed. And interest cost is after that. If I borrow money today and I repay after 1 year, I need to pay some amount of interest because this is the price of credit, time value of money. So transaction costs are incurred before the liability is assumed, and interest cost is after the liability is recognized. So this other cost, you see, they are unavoidable. If an entity has to assume some liability, it has to incur these costs, and these costs do not change the characteristics of a liability. Second thing is what? Qualifying asset, an asset that necessarily takes a substantial amount of time to get ready for its intended use or sale. One asset is acquired and that is ready for its intended use or sale, not a qualifying asset. There has to be substantial amount of time to get ready for the intended use or sale, that form part of the cost of the asset. So borrowing cost, what you pay, there are two possibilities. One thing, it is recognized as an expense. If it is not recognized as an expense, it is added to the cost of that asset. That asset is known as qualifying asset, and that is recovered through depreciation. One amount of interest we can recognize in PL, shown as an expense, added to the cost of the assets. When that asset will be depreciated, that will include this amount of interest that has been added. Next, borrowing costs may include, first of all, interest expense calculated using the effective interest method. So you need to understand what is the effective interest method. In fact, effective interest method is used in the calculation of amortized cost of a financial liability, and it is the basis on which this interest is allocated and recognized in profit and loss during the relevant period. Let's start with this. How do we calculate effective interest? How do we apply effective interest method for transaction costs? Now suppose there is 6% loan. Three years tenure. What is the value? Value is 1000. To arrange this loan, the entity has to pay transaction costs, CU 330. So net amount is 970. Thing is, transaction costs are deducted from the initial recognition of the liability. We have received 1000 rupees. Transaction cost 30 is not charged to PL as an expense. This is deducted from the initial amount. So this initial amount becomes 970. Thereafter, this 30 is amortized through PL during the relevant period. That means 30 rupees every year, 10 rupees into 3, 30 will be amortized. So this 970 will become 1000. Okay? Now, the thing is, in 10 is 1% of 1000. Interest to be paid 7% plus 1% amortization. This is 7%. Journal entry. Is this clear before I go ahead? 6% loan, 3 years, 1000 the initial amount received. Transactions cost incurred for arranging loan is 30. Transactions costs are deducted from the initial amount. Thereafter amortized. 30 rupees has to be amortized. So every year we will amortize 10 rupees, 30. So that the 970 will become 1000. So in the PL we will charge 6% of interest that we have to pay and 1% amortization. So every year we will charge 7%. So at the end of the third year this 970 will become 1000 rupees. Now see the journal entries. Start with the journal entry. First, cash 6% loan. Transaction costs, cash 30. Transaction cost is deducted from 6% loan. 6% loan to transaction costs. That means the value of the loan is 970. 1000 minus 30. Okay? Number 4, interest and transaction costs, CU 70, cash is CU 60 to be paid to the provider of the loan. Balance is amortized 6% loan, that is CU 10. Last one, profit loss to interest and transaction costs, CU 70, CU 70. I repeat, cash debit to 6% loan assumed. Transactions cost incurred 30, deducted from loan. So this becomes how much? 970. Interest 60 rupees plus amortization 10 rupees. 70 rupees is my interest and transaction cost. And lastly, in PL, this is charged. So 60 for the interest paid and amortization is 6%. The loan amount becomes at the end of the year 1 is 970 plus 10 here, 980. Coming 2 years, another 20 will be amortized.